They used to call Enron the smartest company in the room. Not because it drilled oil better, not because it generated power cheaper, but because it claimed it had re-engineered reality itself. In the late 1990s, Enron wasn't just an energy company, it was a belief system. Investors didn't buy electricity, they bought intelligence, they bought complexity, they bought confidence. And that belief pushed Enron's value past $70 billion. Until it collapsed almost overnight. Here's how the smartest people in the room destroyed one of the biggest companies in American history. Enron started as something boring. Pipelines, natural gas, predictable cash flows. In the 1980s, boring was fine, but boring doesn't excite Wall Street. Then deregulation arrived, energy markets were opened up, and suddenly power could be traded like stocks. That's when Enron's leadership had an idea. Don't just move energy, financialize it. If you could turn future electricity into contracts, and contracts into numbers, you could turn imagination into earnings. This is where the story changes. Enter Jeff Skilling, a consultant who believed markets were smarter than rules, and complexity was a feature, not a bug. Under his influence, Enron adopted something called mark-to-market accounting. Here's the simple version. If Enron signed a 20-year deal that might earn money in the future, it booked those profits immediately. Not after delivery, not after performance. On day one, the future was pulled into the present. On paper, Enron became wildly profitable. In reality, cash often hadn't arrived, and sometimes never would. But the numbers looked incredible. This worked as long as no one asked uncomfortable questions. And Enron made sure questions were hard to ask. Financial statements grew dense. Explanations grew abstract. Analysts admitted they didn't fully understand the business, but they still recommended the stock, because everyone else was. One executive famously dismissed a skeptical analyst on a public call, not with an answer, but with an insult. That moment should have been a warning. Instead, it became a meme. When deals went bad, Enron didn't record losses, it moved them. Special partnerships were created, legally separate on paper, but secretly controlled by Enron executives. These entities absorbed debt, they swallowed losses, they made problems disappear. The most stunning part, Enron's own CFO helped design them, and personally made tens of millions from the arrangements. Risk wasn't eliminated, it was hidden. Banks helped structure the deals. Auditors signed off, ratings agencies hesitated. Everyone saw pieces of the puzzle. No one wanted to see the whole picture. Because as long as Enron's stock stayed high, the system rewarded silence. And then reality showed up. In 2001, scrutiny intensified. Journalists began asking how Enron actually made money. Credit agencies grew nervous. Confidence cracked. Once the illusion weakened, it collapsed fast. Stock prices plunged from nearly $90 to pennies. Debt that had been buried resurfaced all at once. By December, Enron filed for bankruptcy. Thousands lost jobs. Retirement accounts evaporated. A company once called visionary became a cautionary tale. The fallout didn't stop there. Enron's auditor collapsed under criminal investigation. Executives were convicted. New laws were passed to prevent similar accounting abuses. But here's the deeper lesson. Enron didn't fail because people were unintelligent. It failed because intelligence was mistaken for truth. Complexity replaced clarity. Reputation replaced verification. Confidence replaced cash. Enron sold the future before it arrived. And when the future refused to cooperate, the present fell apart. So the next time a company is praised as too smart to question, remember Enron. Because in finance, the smartest story in the room is often the most dangerous one. And the question that matters most is always the simplest. Where is the real money coming from?